You've probably been told that to retire early, you need to be some kind of Wall Street wizard, or get incredibly lucky on a high-risk bet. That's just not true. For the last 50 years, the wealthy have used two surprisingly simple income streams to build their freedom, often without the headaches you'd expect. Today, I'm showing you exactly what they are and the beginner-friendly rules you can follow to get started yourself. Let's be honest. Retiring early sounds like a fantasy reserved for stock market prodigies, or the real estate moguls you see flipping houses on TV. But what if the path to financial freedom was much, much simpler? What if it didn't involve checking your phone every 5 minutes for stock alerts, or dealing with a plumbing disaster at 2 a.m.? It absolutely can be. The whole idea behind financial independence, retire early, the FIRE movement, is built on one core concept: creating reliable, hands-off income that covers your bills. Hey everyone, I'm Ryan. On this channel, we don't chase money, we build systems that generate it. In this video, we're breaking down the two easiest and most accessible income streams to fund your early retirement: dividend stocks and hands-off real estate. Forget day trading and risky ventures. This is your no-nonsense guide to building sustainable, passive income. I've used these exact principles to build my own portfolio that generates cash month after month, and I'm going to show you the simple rules I follow. By the end of this, you won't just get it, you'll have a clear, actionable starting point for your own journey to financial freedom. If you're serious about growing your money the smart way, subscribe now and hit the bell icon. Let's start with our first pillar, dividend stocks. If you're a beginner, the stock market can feel like a casino. But this is the simplest and most proven way to get in the game. So, what exactly is a dividend stock? It's simple. When you buy a share in certain companies, you're not just hoping the stock price goes up. You're also getting a piece of their actual profits. These are typically large, stable, well-established businesses that share their success directly with you by sending you cash on a regular schedule, usually every 3 months. Think of it like owning a tiny piece of a giant, profitable machine. Every quarter, that machine sends you your cut of the earnings, just for being an owner. That's it. That's pure passive income money you earn without lifting a finger. The real magic for early retirement is the compounding effect. When you get a dividend, you can take the cash, or, and this is the powerful part, you can automatically reinvest it to buy more shares. Those new shares then start generating their own dividends, which buy even more shares. It's a wealth-building snowball that can dramatically speed up your journey. But how do you find these stocks without spending all day reading financial reports? This brings us to the beginner's rule for dividend investing. Do not just chase the highest dividend payment. That's a classic rookie mistake. A sky-high yield can be a huge red flag that a company's in trouble. Instead, follow this guideline. Look for companies with a long history of consistently increasing their dividend payments. Specifically, you want to find dividend achievers or dividend aristocrats. These are companies that have raised their dividend for at least 10 to 25 years straight. That track record is a massive vote of confidence. It shows financial health, smart leadership, and a business model that can survive recessions. The second part of this rule is to check the payout ratio. This tells you what percentage of the company's profits are being paid out as dividends. A healthy payout ratio is generally in the 30% to 50% range. If a company is paying out 90% or 100% of its profits, there's no money left to grow the business or survive a bad year, putting that dividend at risk. It is worth noting, however, that some stable industries like utilities can often sustain higher payout ratios. So, where do you start? The easiest entry point for a total beginner isn't picking individual stocks. It's starting with a dividend ETF, or exchange-traded fund. An ETF is like a basket that holds dozens or even hundreds of different dividend stocks for you, giving you instant diversification. A very popular example is an ETF like SCHD, the Schwab U.S. Dividend Equity ETF. which holds over 100 high-quality U.S. stocks, all vetted for financial strength and a history of paying dividends. Once you have a solid ETF base, you can start adding individual blue-chip stocks. These are the titans, massive household name companies with rock-solid finances. Think of a company like Johnson & Johnson or Coca-Cola, which are dividend kings that have been paying and increasing their dividends for over 50 years. People buy their products in good times and bad, creating the stable cash flow you want. Getting started is as simple as opening an online brokerage account, which takes a few minutes. You can start buying these ETFs or stocks with just a few dollars. The goal isn't to get rich overnight. It's to invest consistently, reinvest those dividends, and let compounding do the heavy lifting for you. The second pillar of a simple retirement plan is real estate. I know what you're thinking. Dealing with tenants, fixing leaky toilets at 2 a.m., and saving up a giant down payment. Forget all that. We're talking about passive real estate, where you earn rental income without ever being a landlord. The secret here is real estate investment trusts, or REITs. A REIT is a company that owns and operates a massive portfolio of properties. Think apartment buildings, shopping malls, data centers, you name it. And by law, they have to pay out at least 90% of their taxable income to shareholders as dividends. When you buy a share of an REIT, you become a fractional owner of all those properties. You get the benefits of real estate, like collecting your share of the rent, without any of the landlord headaches. And since REITs trade on the stock market just like stocks, you can buy or sell them in a heartbeat. So, how do you pick a winner? We can adapt a classic real estate rule for passive investing. Focus on diversification and professional management. Instead of trying to find that one perfect property, a beginner's best move is to invest through a diversified platform. There are two fantastic ways to do this. First, just like with stocks, you can buy a REIT ETF. An ETF like VNQ, the Vanguard Real Estate ETF, gives you exposure to hundreds of REITs across every sector of the real estate market in one shot. It's instant diversification. The second and increasingly popular option is using real estate crowdfunding platforms like Fundrise or RealtyMogul. These platforms pool money from tons of investors to buy large-scale private real estate, like apartment complexes that were once only available to the ultra-wealthy. You can often start with just a few $100s, and they handle everything. You just invest and collect your share of the rental income. Think about it this way. Instead of saving $50,000 for a down payment on one house, you could take $10,000 and put it into a diversified crowdfunding portfolio spread across dozens of properties in different cities. Your risk is instantly lower, and your only job is to watch the income hit your account. The returns can be attractive. Historically, many REITs and crowdfunding platforms offer yields that can range from 4% to 8%. Plus, your investment can grow as the property values appreciate. While yields fluctuate, for example, VNQ's dividend yield is around 3.6%. In early 2026, it's a hands-off way to build a real estate empire, one small piece at a time. So we have dividend stocks on one side and hands-off real estate on the other. Why are they so powerful together? Because they give you diversification across different types of assets. The stock market might have a down year, but your real estate income can stay solid. If the housing market cools off, your blue-chip dividend stocks that sell essential products can keep churning out cash. You've probably heard the stat that the average millionaire has 7 streams of income. Whether that number is exact or not, the principle is what matters. Don't put all your eggs in one basket. These two are the foundational pillars you can build everything else on. You can use the cash flow from your dividends to invest in more real estate and vice versa. They feed each other, creating a financial engine that works for you 24/7. See? Retiring early isn't about some once-in-a-lifetime jackpot. It's not about luck. It's about building reliable, repeatable systems that generate income while you sleep. With the simple rules we covered today, you have a clear starting line. These aren't get-rich-quick schemes. They are get-rich-for-sure strategies, built on decades of proven results. You don't need a finance degree, and you don't need a pile of cash to start. You just need a plan and the discipline to stick with it. Now that you know the what, it's time to learn the how in more detail. Click the video on the screen for a step-by-step guide on opening a brokerage account and buying your very first Dividend ETF. And finally, if you got any value from this video, do me a favor and hit that subscribe button and the notification bell. I'll be back with more no-nonsense guides to help you build your wealth. Thanks for watching.